Welcome, everyone, and we're at episode 4 of the Finance for Entrepreneurship series. Again, we have the esteemed Mr. Wainman here with us about finance and answer all our questions.
Hi, Donnie.
How's it going, Ted?
It's good. It's good.
Yeah, excellent. Are you enjoying this? Did you enjoy the snow yesterday?
Yeah, snow was fun. Snow was fun. Lockdown isn't fun, but snow is fun.
Snow is fun for about 10 seconds.
Yeah, I'd rather be in the Alps skiing though, Donnie, personally, rather than tromping around it in Putney.
You and me both. You and me both. So, Ted, the last time we spoke, we've spoken about how to set up a business. We've talked about the different types of funding for businesses, equity and debt. And last week we spoke about equity financing. So can you remind us a little bit about equity and debt financing, and then we'll go into more details?
Absolutely. So good to see you, Donnie. So we're going to be obviously talking about debt, that millstone around your neck that you cry yourself asleep to sleep every evening over. And obviously we talked about any business that's raising capital, they're raising it from debt and equity. If I lend you money, you've got to pay the interest, you've got to repay the capital, and therefore companies, if they can service the debt, if they can pay the interest, then they might be able to refinance rather than repaying the capital. They can borrow over here to lend over there. Obviously, we talked about equity as well, where you're giving away a share part of the business, the dividend you don't have to pay, and the capital you also don't have to repay. So an equity investor, they're not looking to get their money back like the debt investor, they're looking to get out of their investment. How do they realize that investment? By selling it to someone else. So if you remember that, we kind of just that's a quick summary of what we covered. I think it was in the second video. So anybody who's watching kind of slightly missed that might want to go and watch that video to get up to speed with debt and equity and the intricacies of each.
Yep. So how do we measure like the affordability of debt versus equity?
So here we're looking at the income statement. This is a sort of a standard template of an income statement. And what you'll notice is that the interest, which is the cost of debt, appears in a very specific place. So we always start off with the turnover, which is sales, less cost of sales equals gross profit. That's our trading account. We then deduct our operating costs, which is the cost of running the business: rent, rate, light, heat, finance, HR, sales, marketing, sometimes referred to as SG&A, sales, general and administration. Those are the operating costs. And that gives us our operating profit. Then we deduct the interest. Okay, so the interest is deducted from profit. So Donnie, for example, if you apply for a mortgage here in the UK, they'll ask you to fill in a form and they'll say things like, how much do you spend each month on socks? Now, I don't know about you, Donnie, but I don't buy socks on a monthly basis. It's a stupid question. But basically what they're trying to do is they'll say things like, how much do you spend on food? Because Donnie, if you don't eat, you'll die. And if you die, you won't be able to pay your mortgage. Okay, so the mortgage company is very concerned that you carry on eating.
Yeah.
And then it'll say things like how much you spend on travel to work, maybe a bit academic in the lockdown, but you need to go to work, because if you don't go to work, you'll get fired. And if you get fired, then you won't be able to pay your mortgage. So they're very concerned about the affordability, and that's what they're measuring. And then they'll ask you things like how much you go on holiday and spend down the pub and all that kind of stuff. So in exactly the same way, the affordability of debt for a company, we're measuring the interest that they pay against the operating profit. Effectively, we're saying, is there enough operating profit after deducting the cost of the things that you're selling and the cost of running the business to pay the interest, which is the cost of the debt that's funding you?
Okay. So overall, right, debt is cheaper than, we kind of discussed this before.
That's absolutely. Sorry, go on.
Oh, no, I was just going to say it is riskier to the company, right? Even though
it's riskier to the company. So the equity, the investors, they might not get the dividends, they might not get out, the share value may go down. They're taking a much higher risk than the debt investor, who is expecting to get their money back in form of interest and the capital repayment. Yeah. So if the debt investor sees it as lower risk, then for the company, it's going to be cheaper. Yeah. But it's going to be higher risk for the company. So if you're the company and I'm the investor, Donnie, you've got to pay that interest. You've got to repay that capital.
Yeah.
And therefore I will accept a lower rate of return. It's not going to cost you as much.
Yeah.
And when we're talking about cost, Donny, we're talking about, you know, if you need $100 to launch your business and you come to me and you take a loan, you've got to give me that $100 back. But if I say I'll give it to you as equity and I want 50% of your company, when you turn into a unicorn, that loan, in inverted, or that investment has cost you $500 million because, you know, effectively you gave away half of your company for it.
Yeah, yeah, and obviously, when in terms of the risk, it's not just that you have to pay the money back, but there's also risk on, you know, going broken and all the other things that are associated with that, right? So
Absolutely. So if you do go broke, the debt investors get paid before the equity investors.
yeah, yeah,
So it's slightly lower risk. There's a possibility that a debt investor is going to get some money back. The equity investors probably going to get nothing.
nothing. Right, right. So why would a company choose debt as a financing option?
Okay, well, that's a good question. So if you remember in the last video, we talked about equity and how equity it's kind of low risk. You don't have to pay any dividends, but you are giving away a piece of the pie. You know, you are giving away part of your company. So the best way to describe the effect of debt, Donny, is a little example. So I want you to imagine you've got a rich uncle in America. You didn't know about him. He's just phoned you up and he said, Donny, here's $1 million for you. So here's $1 million bill. And you'd be feeling pretty happy with that, no doubt. And you've decided that you're going to invest in the property market. So you've got a couple of houses you could buy, Donny. You can buy this house for $1 million, or you could buy a slightly bigger house for $10 million. The first house, you're not going to need to borrow any money because you've got the equity of $1 million that your uncle gave you, and that's going to buy the first house. The second house, you're going to need $10 million. You've only got $1 million that your rich uncle gave you, and therefore you're going to have to borrow the other $9 million. Everything making sense so far, Donny?
Yeah. Okay.
Excellent. Now, let's say that house prices double in value. Well, this first house is now worth $2 million. You don't owe the bank anything, and therefore your equity investment is now worth $2 million. You've just doubled your investment, and you'd be feeling pretty pleased with yourself, Donny.
I would.
This second house is now worth $20 million. You still owe the bank $9 million, so your equity is now worth
$11 million.
Well done, Donny. $11 million. And you're very happy with that. And the reason for that is what we call leverage. And leverage is defined as equity over capital. And equity over capital in this example is the equity, the capital is on the top, which is the amount is invested in your house. The equity is what your personal stake is. And what you can see is that you are for the underlying asset going up in value by, doubling in value, your personal investment has gone up by 10 times. So it has a leverage effect. And this is where people talk about leveraged investments or leveraged trading. They're using debt in order to invest and to multiply the return for the equity holder.
Yeah.
However, Donny, before you get carried away, let's just think about what happens if house prices halve. This first house is going to go down to $500,000. You owe the bank nothing, and therefore your equity is now worth $500,000. You've lost $500,000 that you inherited from your rich uncle.
Yeah.
This second house, meanwhile, has gone down to $5 million.
Yeah.
You still owe the bank $9 million, so your equity is now worth
-$4 million.
Absolutely. Not only have you lost $1 million that your rich uncle gave you, you now owe the bank $4 million that you haven't got, and you'd be very unhappy with that.
Yeah.
So once again, we're demonstrating the kind of the riskiness is that companies with lots of debt, high potential return to the shareholders, but the model is much, much riskier.
So what are the different types of debt?
Okay, so there's lots of terms out there in terms of the different types of debt. And really, when you're looking at the different types of debt, it's about the ranking order. So if a company goes bust, everybody forms an orderly queue, and the people who are at the front of the queue get paid first, and the people at the back of the queue get paid last. So typically, the equity investors are right at the very back. They're taking the most amount of risk, which is why they want the biggest potential return. And so what we find is that the people, the debt providers who are likely to be paid first, they are taking a lower risk than the people who get paid after them. So you might imagine that, you know, we put a company into liquidation, we sell the assets, we pay off, well, the liabilities. And what we work out is that not everybody, we can't pay all the liabilities. So some people are only going to get a proportion. But if somebody says, hang on a second, I've got senior debt, I get paid before anybody else, they get all the money, and everybody else only gets money if there's money left over.
Right, right. So those are some interesting terms there, Ted. Can you expand a bit more about those?
Absolutely. So, for example, senior debt is typically first in line. So if the company goes bust, then the senior debt gets paid in full before any subordinated debt, which is subordinate to the senior debt. Obviously, that means that the senior debt is lower risk, and therefore you would expect to be paying a lower rate of interest on that debt. Subordinated debt is higher risk, therefore you'd expect to be paying a higher rate of interest. Junior debt, last in line, and often junior debt and subordinated debt are used interchangeably, because typically you'll have one debt provider who's the senior debt and then somebody else who is subordinate or junior to the senior debt, for example. But again, it's working out, if you're investing and you're lending money in, you need to work out where do you sit in the kind of ranking, and can people come in ahead of you? And in terms of the company, it's what's the interest rate that you're paying on the different types of debt, and is that commensurate with the risk that they're taking?
Right. And I'm guessing that your credit score as a company as well would influence which one of those you would get access to, or which
well,
one
it's not so much access to. Don't forget, if there is no senior debt, then subordinated debt is the senior debt by definition. Right. So you're absolutely right that that your credit rating, if you have one, will reflect the risk that the debt provider is taking, and therefore will be reflected in the interest rate that they will charge you.
Right. Okay.
So this is a relative risk thing.
Yeah. Okay. Cool. And I noticed you left out mezzanine there. What about that one?
Yeah, so mezzanine, a little bit more complicated. So this is typically what we call a hybrid debt issue, and it'll be subordinate to the other debts that are an issue. And often you will have equity instruments attached. So we're talking a lot about debt or equity, and we're kind of talking about one or the other. Mezzanine kind of sits in the middle, and it says, well, I look like debt, but actually maybe I'm equity. So this is where you have the option. You lend money to a company, but you have the option to turn it into equity, for example. And this will often increase the value of the subordinated debt. So, you know, if you think about it, if I have subordinate debt, it's higher risk, but then suddenly I have the option to change it into shares, and the company is going to go ballistic, then actually that has a greater value to me. And this is frequently used with acquisitions, buyouts, and maybe used to prioritize new owners ahead of existing owners in terms of bankruptcy. Right. And quite a good example of that, you know, we were talking about this earlier, that I was just looking at Roo Foods accounts. Roo Food is the owner of Deliveroo, who you may have heard of, Donny. Yep. And they've just had a big investment of, as you can see from here, about £200 million of short-term finance. This is provided by Amazon, which is quite an interesting one, thinking about Deliveroo just ahead of its flotation. Mm-hmm. So Amazon has invested this money, and you'll notice in the note it says the short-term finance is convertible at the option of either party, which means that either Roo Food or Amazon can choose to convert that into equity. Yeah. So if you think about it, if the company goes down and goes bust, Roo Foods will probably try and translate it into equity. If the company goes ballistic and takes over the world, then Amazon will want to turn it into equity. But if the company just tootles along and doesn't really do anything special, then Amazon can just turn around and go, actually, you know what, I want my money back, and they can just extract it very, very easily.
Yep. So Ted, in just so you use the term convertible here. So is this like what you would term a convertible note?
Absolutely. So convertible debt is a form of mezzanine finance, and it's this kind of, think about mezzanine as a halfway house. It's kind of it's debt or it's equity, and sometimes people structure it as to how do you want to present it. So if you look at Roo Foods' balance sheet, their net assets are negative at the moment. That doesn't look very good. But then when you see that they got 200 million of finance provided by a shareholder, you kind of think, well, they're not going to put the company into liquidation. They want the company to actually succeed. So it's worth digging a little bit. And sometimes we do it for presentation, if that makes sense.
Yeah, yeah. Okay. So obviously there's a cost to borrowing funds, right? So how can a company reduce its borrowing costs?
Well, you mentioned, for example, the credit rating of the company. So if you can increase its credit rating, make it more credit worthy, bigger cash flows, deeper pockets, then obviously that's going to anything you can do to improve the confidence of the lenders. But some specific and actually to reduce your borrowing cost, you can also reduce the debt. Obviously, if you halve your debt, then your borrowing costs will halve. But sometimes to halve your debt, you then need to go to equity financing, and we're back in that kind of debt equity debate. Or you need to sell your assets, and you don't want to sell your assets because you need them to run the business. So what are the other options to you? So you could get a fixed security. So a fixed security is a loan that is fixed on a specific asset. So typically like a car, for example, you hear stories about people who buy secondhand cars and then suddenly find that actually the hire purchase hasn't been fully paid off by the person selling it, and they don't actually own the car, the hire purchase company. So they've got a loan, it's fixed on the asset, and that company has first dibs on the asset until the loan is paid off in full. So that's caveat emptor. So this is typically, you'll see a company, they'll lend the money and they will fix it on what it's being used to buy. So if it's cars or plant and machinery or equipment or computers or whatever. Yeah. Another form of security is what we call a floating security. So floating is where it's kind of floats over a group of assets. So for example, I may lend you the money and it floats on your inventory. And what I'm saying is that, obviously that means you can still buy and sell your inventory, but if the company goes into liquidation, I get first dibs on the inventory and everybody else forms an orderly queue. So the fixed guys will come in and say, that's my car, that's my computer, that's my piece of machinery. The floating will come in and say, well, I've got it over these assets here, anything which is left, for example, maybe trade receivables as well. And this is often where you hear of things called covenants. So a covenant, for example, if I lend you $1 million and I secure it on your stock, I might have a covenant that says you have to maintain a minimum of $2 million of stock, for example. So you often hear about companies who breach their covenants, and a covenant is a kind of terms of the loan so that the lender feels confident that if things are going wrong, they can get their money back. So if you breach that covenant, they then come in and say, I want my money back straight away. And it's a way of getting out quickly. So light is without the covenant. Now, the final way to reduce is through personal guarantees. So security provided by directors on personal assets, and this breaches the veil of incorporation. So you may remember we talked about the veil of incorporation in the first one. We talked about the structure of a company, a limited liability company, and we said the shareholders are limited to the extent of their investment. Well, Donnie, if we're setting up a business and we go to the bank and the bank says, I'm not going to lend money to the company, but Ted, I will take your house as security, the deeds to your house. Effectively, if the company goes bust and there's not enough money to pay the bank, they take my house. Okay, so it's a way of the bank getting around that veil of incorporation. And often you see directors have had to take out personal guarantees. Sometimes it's limited, sometimes it's unlimited in order to be able to secure financing.
Yep. Okay, cool. So what are the other advantages of debt finance, Ted? Are there tax advantages?
Well, it's interesting you say that. So again, we go back to where interest actually appears, and you'll notice that interest appears not only below operating profit, which is our affordability measure, it appears above tax. So if you have more debt, Donnie, guess what? You're going to pay more interest, and the more interest you pay, the less tax you pay. So this is what's known as a tax shield. Now, not relevant to startups, but this is a good example for water companies. So I was looking at a water company recently. They had a ton of debt, something like 80% debt funded, and something like 25p of every pound paid by their customers goes to paying the interest on the debt. And interestingly enough, the debt is provided by the shareholders. So again, it's just another way of the shareholders financially structuring a business to get the money out, but it makes it very, very tax efficient for them.
Right. Cool. And what about bonds? I've heard of bonds, and you can buy bonds and such, but what are they?
Okay, so a bond, and you're absolutely right. So bond is it's what's called a tradable loan, and people often think about that and say, well, that's crazy. Why would I want, I've got enough debt of my own. I don't want to buy anybody else's debt. But don't forget, if you're buying debt, you're doing the lending. It's your asset, for example.
Yeah.
So let me give you an example. Let's say, Donnie, you want to raise some money and you want to borrow, let's say $100,000 from me. So I'm going to lend you $100,000. I'm going to say that I want it back in 10 years' time. And in the meantime, I'm going to charge you, let's say, 5% interest. OK, and that's basically a form of a loan. So you go where you invest it, you do whatever you need to, you pay me $5,000 a year because that's the interest rate. And in 10 years' time, you give me back my 100,000. Now, that's fine as a loan. The problem with it is that, from my point of view, it's illiquid. So if I suddenly find a month down the line, I need my 100,000. If I phone you up, Donnie, and I say, give me my money back, what will you say?
No.
Yeah, exactly. You've got to pay that because I don't have to give it back for 10 years. So what we might do, Donnie, is rather than you taking out a loan, you issue me with this piece of paper. Okay. And this piece of paper is a bond. And it means that if I need the money next month, I can go into the bond market and I can say, look, Donnie owes me $100,000. He's going to pay in 10 years' time. In the meantime, he's going to pay this rate of interest. So the 100,000 is what's known as the nominal or face value. The 10 years is what's known as the maturity date. And the 5%, we don't call it interest, we call it a coupon, but it's the same kind of concept. And I can sell it to anybody else in the market. Now, as a startup, you're not going to be using bonds to manage your to invest in your business. So you are going to be using loans and equity. You're not going to have access to the bond markets. This is for very big, very mature companies. And often you find that companies who have lots of cash are buying bonds, and the other big buyers of bonds are people like insurance companies, pension funds, and asset management houses. So it's a way it's a way for large companies like Vodafone, for example, borrowing money from big institutions like pension funds, rather than just going to the bank manager like you and I. So that's what a bond is, but you're unlikely to come across it as a small company or as a startup.
This is interesting. I have one quick question on this, Ted. So with regards to the bond, can you ever buy a bond under face value?
Absolutely. So Donnie, if we look at this bond here, for example, the price of this bond is set by the market. So if you pay 50,000 for this bond, effectively you're getting a much higher yield. So in 2011, if this bond had been issued by Greece, whose cost of borrowing was 35% at the time, that would have valued this bond at about $18,500. Obviously, it would be in euros because it was Greece. Okay. And not only can you pay less than the nominal face value, you can also pay more than the nominal face value. So if you pay, I don't know, $125,000, then your coupon, your effective yield on this bond is going to be much lower. And what's interesting right now is that if you buy this bond today, Donnie, you're going to receive a total of $150,000. Okay, that's the $5,000 a year for 10 years and $100,000 in 10 years' time. So it's a total of $150,000. Something like 25% of the world's government bonds that look like this are trading at above that total amount, i.e. the negative yield, which means that you're guaranteed to lose money. And that's a completely different discussion, I'm afraid, Donnie. We haven't got time to go into the implications of that.
Episodes.
But it's a little bit crazy at the moment. But the point is that these bonds then trade at market value, which is great for people like Vodafone because the market sets the cost of debt for Vodafone. Whereas you and I, when we go into a bank, we have to, the bank manager says, here you go, 7%, take it or leave it, and we kind of have to take that. But the market will look at Vodafone and say, yeah, Vodafone's not that risky, and therefore will accept a lower rate of interest. They'll actually bid up the price of these bonds as a result.
Yeah. Okay, cool. So would you recommend debt to fund a startup?
Well, that's a good question, Donny. I quite like this quote. Most of the world's problems are caused by debt and by drugs. And while drugs are predominantly illegal in most countries around the world, debt is tax deductible. So it looks to me like there's a sort of, lots of people want people to take on a lot of debt, but they don't want them to be using drugs. I mean, I think the answer is that, you can use debt, but just go in with your eyes wide open, because if you can't make those interest payments, if you can't hit the capital repayments, if you can't get refinancing, then all your dreams can go to dust very, very quickly. So with the equity, you do have that nice environment where the equity investors, they can't take the money back. And we did talk a little bit about control, about investors wanting to get directors onto the board to influence the business. They're going to be probably going to be much more involved in the actual business. So debt is a lot more kind of arm's length investment, is a little bit more standoffish, but it is riskier. So you've got to be really confident of your business model. If you're not confident of your business model, if you don't think you can make your interest repayments, then maybe debt isn't for you. So there's a kind of sense here of, I don't know, Donny, let me ask you a question. Do you drive a car?
Yes, I do.
Do you put a seatbelt on each time you drive?
Yes, I do.
Do you put a crash helmet on each time you drive?
No, I don't.
No, exactly. Okay. And the reason you don't put a crash helmet on is, yes, it would probably be safer for you, but it's not worth it. So what you do is through that is you demonstrate your appetite for risk.
Right.
And exactly the same way, it's a bit like saying, should you have comprehensive or third-party insurance on your car? It's actually reflected in your appetite for risk.
Right. Okay. Cool. I mean, this is really interesting. I enjoyed the last one. I enjoyed this one. I think it's really, really important for businesses to understand the difference and how they can use it, and where in your journey as a startup or business, where you can apply different ones. Right. It's quite interesting stuff. So, yeah, thanks for that, Ted.
Okay, no worries, Tony. It's always good to speak to you. If anybody who's watching has got any questions, then put them in the comments. If you've got any topics that you want us to cover on these videos, then again, put it in the comments. And I look forward to speaking to you next time.
Yeah. So Ted, what are we going to be up to next time?
So next time, Donny, very important, we're going to be talking about the role of directors and getting people who are actual directors of their business to understand some of the responsibilities that they actually have, and the legal responsibilities, as well as the kind of, the what you would expect the responsibilities to be. And also for anybody who's not a director formally, but is actively involved in the decision makers. Maybe you are a director. So all will be revealed on the next video.
Oh, excellent. So thanks again. And thanks everyone for listening in. As Ted noted, if you have any questions or comments or want us to talk about a specific topic, drop it in the comments, and we'll see you guys again soon. Bye.